For apartments today, we try and find assets that are really well located, but have some dated interiors, dated exteriors. So high demand, but lower than
Hey
market
there,
rents.
I am Dr. Jason Ballara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why? Hi, everyone. I'm Jason Ballara, and this is the Know Your Why podcast. Today, I'm here with Mark Khuri. Mark has been an avid real estate investor for 17 years, and throughout his career, he's been involved in sourcing, underwriting, acquiring, raising capital, rehabilitating, managing, and selling both residential and commercial investments. Mark, sounds like you've done it all, and I'm very excited to dive into your story. But first, I just want to say thank you for coming on the show, taking the time out today to come talk to us. So thank you very much for being here.
Man, my pleasure, Jason. Thanks for having me.
Yeah, absolutely. Why don't we start with just let us know, kind of tell us your story, your background, what got you into real estate, kind of all that, and then we'll just go from there.
Sure. Yeah, I'll try and keep it brief. So Jason, for me, it kind of started out of college. I was working in finance for corporate America for a number of years, and quickly realized that that probably wasn't for me. I was very focused on, how do I create long-term passive income through multiple streams of income and really become financially free. That was always the goal. But I worked at corporate America for about 8 years, and throughout that time, I started investing in real estate on the side. Very active investing, buying fixer-uppers, partnering with family members, my brothers, my folks. And we had built a small portfolio over the years through the recession. This is 2005 to 2010. And by 2010, I was just hooked and left the W-2 world. And we started our company, SMK Capital Management. That's my father and I's initials. And the goal at the time was just to keep expanding, to raise capital from others that trusted us and liked us, to keep buying. We were buying a lot of distressed properties from the bank at the time, REOs, short sales, foreclosures, some boarded up properties that needed a ton of love and attention. And we're doing that in a few markets. And so that's how we got our start. Today we really have evolved to more of a private equity real estate investment company. What we do is we partner with other operating partners or sponsors in different asset classes like mobile homes and self-storage and ATMs and apartments. And we analyze a ton of deals. Roughly about 97% of the deals we see, Jason, we don't invest in. Working with the best teams out there and being very selective with investments for our investor group. So I'll pause and see what questions that brings.
Yeah, thank you for that. I mean, I think there's a lot of interesting things to sort of dive in here. One, you starting that journey around the recession is always intriguing to me, to hear people that were kind of involved at that time and hear what your experience was, leading up to. And I was alive then. I owned my own home kind of in and around that time, and so I experienced it on a small level. Wasn't really investing heavily at that point, but I know just when I've talked to other guests about that went through it, kind of, I think the stories that people encounter in a recessionary environment and how you got through that and all that is helpful for people to hear, and also speaks volumes, I think, to track record. So maybe just talk about that time a little bit.
Yeah, happy to, Jason. I'll say this: we've always been focused on, I would say, how do we create value manually? What can we do to grow the assets, either income or valuation or both? And so from the early days, again, we were buying, homes. A lot of times the purchase price was less than the renovation cost, Jason. So putting a ton of money back into these rehabbing houses. And that's how, through the recession, you're buying deals at some of the deals we bought back then, Jason, were 60% off what they had sold for just 2 years prior. And so you're seeing these huge discounts, and then buying them in a distressed fashion and being able to add value has been a huge part of our focus. It remains our focus today. Although today we also like to have income. So we're really looking for properties that are stabilized, meaning there's, 90, 95% occupancy when we buy them, but there's something wrong with them that we can fix, a human error, some kind of manual process we can go through to improve the property significantly while earning cash flow. So we kind of gotten spoiled and we like both. But that's a bit of this transition. I'll share some things, through the recession. Maybe we got a bit lucky. Like some of the loans that you hear these horror stories of folks who had these adjustable rate loans and they went from, X to Y and their mortgage rate went up by hundreds of thousands of dollars a month. And it caused them to, of course, not be able to sustain the properties. I somehow got lucky. The first property I bought had a 5-1 arm. So after 5 years, the interest rate adjusted, but it adjusted down. So the timing of when I bought it and when it adjusted was just out of my understanding at the time. I didn't know what I was doing, but I got lucky. Yeah. And so that's one story. I think a few other things that are helpful is just we never sold anything from 2008 to, probably not till 2013, 2014 did we start selling. And when you look back now, you're like, wow, I wish we had waited longer, But the key to persevering through the downturn was just not selling at the wrong time. And that's the story with real estate. If you can keep holding, if you can keep cash flowing, and not everything cash flow through the recession, we saw rents go down in certain markets by 20%. But we write a check, right? You make up the difference to keep the property going, and then of course you see the merit of that risk, and then the reward comes later. And so we didn't start selling until several years after the recession had essentially started to turn in the other direction.
Yeah, some really great points there. I mean, one is just that piece about this. You don't actually lose any money unless you go ahead and sell it when the market is down, right? So if you're looking at strictly market conditions, yes, on paper your value goes down. I mean, it's similar if you're looking at the stock market, right? The stock market goes down. If you don't sell it right then, you didn't lose any money. These are, kind of unrealized gains and losses until you exit whatever the asset is. And so I think that's an important thing for people to understand, that, and this points to the type of debt that gets used or you factor into whatever your strategy is making sure that you're not in a position to be forced to sell. And so if it's, you're in a market like we were in 2009, 2010, or in a market that we're in, I guess now, like, not, if you don't have to sell, probably not the end of the world. Like you said, sometimes cash flow goes away. There's things to adjust to, but at the end of the day, most of the money is made at the sort of exit on real estate. The other thing you mentioned is sort of the value add component to what you're doing, where there's two types of appreciation. There's the market appreciation, and then there's that manual appreciation that you referred to. So that, I think, is something that maybe gets missed in the when the market is turns for the worse, is sometimes you've done enough from a value add play that it doesn't, maybe your values haven't gone up as much as it would have, but it doesn't hurt you as bad because you've sort of manually increased those values. So what kind of things do you do, Mark, to do that? And it's probably different per asset class, but what kind of things are you looking at from a value add strategy?
Yeah, maybe I'll break it down, just give you a quick overview of each asset class, Jason, because each one's a bit unique. We'll start with apartments because most people can know and understand them pretty easily. But for apartments today, we try and find assets that are really well located, but have some dated interiors, dated exteriors. So high demand, but lower than market rents. And through renovation and through organic growth of the market, we can grow net operating income. And so renovating units is a big one for apartments. There's also a lot of other, what we call other income items, like different ways to add revenue streams to a property other than just renovating units. And that can be through different amenities that you add to the asset, billing back utilities, cable, internet. There's different ways to do things there that help the bottom line. But a lot of it does come back to what are you buying in the first place, right? So if you have a brand new property, it's a little harder to grow the value because there's not much more you can do. It's just brand new, right? It was just built a few years
Right.
ago. Rents are already at market. Those deals, Jason, we'll typically only look at if there is some kind of unique tax structure, like tax exempt apartments where we're not paying property taxes. Okay, well that's interesting. Let's learn more about that, right? So we've been doing a lot of property tax exemptions for the last couple of years. Then if we shift to, self-storage is a good one to talk about. A lot of times what some of our operating partners do, Jason, they focus on buying from mom and pop owners, husband and wife. They've owned this asset for 20 years. They're tired. They're getting a little bit lax with their oversight, their management. They haven't raised rents in 10 years. This is something that we just recently invested in. So I'm actually speaking verbatim to this deal. And, in this case, one of the husband had passed away. They're in their 80s. The wife doesn't want to deal with it anymore. She's not even, barely collecting rent, right? There's a box at the property people can slip an envelope into. And there's virtually like no online presence, right? So if you go look for storage in that local market, you don't even really find their facility. So occupancy was at this deal 70%. And the going in rents, again, 10 years hadn't raised rents. So that like a 10 by 10 storage unit at this property was around $80 a month, where the market was charging over 120. And so you just have this property that through, I would say, human error and just lack of effort has provided an opportunity, right, for us to come in and add value and raise rents, increase occupancy, start online marketing almost immediately. So those are the kinds of deals we like to see where there's a story behind them, Jason, of how we can take it from A to B and feel really confident that we can execute on that story and the business plan. And then maybe lastly, we'll just talk about mobile home parks, which has been a big part of our investment portfolio for over 10 years. You do have a lot more potential value add in mobile home parks than some apartments, for example. So a lot of the parks we buy are usually 70, 80% occupied. So they have vacant lots, Jason. You can bring in new homes to these communities and sell them or rent them. And that can increase the bottom line very significantly and in a rather short period of time, 1, 2, 3 years. And so we look for those kinds of communities that are undersupplied from affordable housing standpoint, and then we try and increase the supply of affordable housing. And we've just find that the fruits of that labor are well worth it. So those are a few of the value add measures that we'd like to see.
Thank you for breaking that down. I think those are important things for people to understand. Sort of it may differ per asset class, but also within asset classes, it's not just one thing. It's not just renovations. It's not just, finding a mom and pop. Like you can combine strategies. You mentioned adding more, other income streams. So, but one thing you said, Mark, that I want to highlight because I think people sometimes miss, from out, non full-time real estate investors. You said we can, add these value propositions. You were talking about mobile home parks, but you can have it in a short time, 1, 2, 3 years. And for a lot of people, that's not a short time. Like that's not how they look at time horizons. And I think that's been one of the things that has struck me when talking to potential investors. It's like, look, we're doing this over, we have a planned hold time of 5, 7 years. And so people list illiquidity as one of the downsides to real estate. And I really think it's kind of one of the upsides to real estate in the sense that you don't make rash emotional decisions and as we mentioned, like sell when things are down because you're worried. Like you just stick to the business plan and go forward. But I just like that you sort of combined a short-term horizon with 3 years. And I think that's just an important thing for people to understand in real estate is it's a get rich slow sort of prospect, but definitely achievable over time.
Yeah, I'll add some commentary there, Jason, because I agree. when you initially start out in this industry, in this investment space, if you're doing predominantly single family homes or small multifamily, which is how we got started years ago, 1 to 3 years is a long time. And so
Right. Right.
I get it, right? You're flipping a house, you want to be in and out in 6 months
Yeah.
if you can. And so, but what we're talking about is definitely more of an institutional scale. Like a lot of the apartments we invest in are 3, 4, 500 units, right? And same with mobile home parks; they're larger in size, larger in scale, and the same with self storage. And so, if you're going to come in and renovate a property, you have a lot more to do. Let's just be honest. And so it takes longer. And then in the case of a large apartment community, we're not kicking tenants out. We renovate when leases come up for renewal. And if tenants don't stay, then that unit becomes available for renovation. So you have to run through the
Sure.
rent roll, once or twice, sometimes 3 times before you get to renovate the majority of the property. And then lastly, what's also stress for us is, while we're doing the business plan of creating and growing the value, we're also looking to earn income, right? So we get quarterly distributions of the net cash flow, and we pass that through to our investors. And so you're earning passive income in the same time as growing the asset value.
Yeah. Yeah. And you mentioned something that you sort of touched on before that I think is an important point, especially right now, where maybe touch on how you balance occupancy with that value add strategy. Because I think 2 years ago, even people were like, oh, we just go in there, we get everybody out who's under rent, and we renovate those units, and then we're able to charge, X hundreds of dollars more per unit. And then when the market changed so dramatically, then people face problems with occupancy, and unit. So your cash flow's down. You're still trying to renovate. I mean, these are problems that a lot of people have faced, ourselves included in some examples. So how do you sort of address things like that? And you touched on a little bit, but maybe expand on how you
Sure.
navigate that timing piece.
Yeah, I mean, I'll share a couple thoughts here, Jason. A lot of our operating partners today are using, AI driven revenue management software at the property
Mhm.
level. And so for those that aren't familiar with that, it's a pretty sophisticated software that changes the rental rate or the pricing of your product every day based on local area comparables, based on the current supply and availability at your community, and based on something, other factors. One of them is staleness, like, hey, how long has this unit actually been vacant? And these kinds of factors. And so it's pretty robust and provides a lot more accuracy into, pricing. Now, with that, each property is going to be a little different in relation to your question of when to renovate and how quickly and at what extent, right? So in general, what you're looking for is you want to maintain occupancy. Usually for us, we want to be over 90, 92% on apartments specifically, where at that point you feel like, okay, we can start pushing a little bit more on the rents. Let's see where the ceiling is. And then when units come up for renewal, perhaps the rental rate on that unit, the tenant's been there for a couple of years and we've just been raising it slowly. I'm going to make some numbers up here. Let's say it's a 2 bed, 1 bath, and it's 1,300. But if we renovate it, we know we can get 1,600. And so what do we want to do? Do we want to ask that tenant to stay and charge them 1325, or would we rather that unit come vacant? And you'll make that decision based on, math, and then of course what the tenant's desires are. A lot of times you can move them down the hall to another property in the same community that has been renovated if they're looking for that. Or if they're just digging their heels in, occasionally you might want to push the rents pretty high on that renewal notice so that they
Mhm.
would choose to vacate. Now, we don't do that very often, but there's options there when the units come up for renewal on what to do to meet the business plan, to meet the stable occupancy, and to keep things going. Now, if you're seeing your occupancy like, gosh, we've got 15 renovations going on right now, this unit just came up for renewal, we want to keep them and we don't want to renovate right now. So then you will adjust your process for that renewal with that resident accordingly. And so it's really a case by case scenario, depending on all the conditions noted there.
Yeah. The so those decisions you're making, that you've got AI software that you're using to with the pricing and things like that, but I'm assuming then kind of on the back end, you're making those higher level decisions as to how far do we want to push these renovations to maintain occupancy? Where does I guess, and maybe this is hard to answer and it's, property dependent, but where does that sort of use of the software and sort of the asset management from an actual person kind of take over in that process?
Yeah, good question. So the software is a suggestion of what to do with pricing. There's a team behind all of that, looking at that information daily, Jason, with weekly calls, going through the analysis of what's best for the property and then making that decision. And so that's really how you see it. It's more of a tool, not a complete deciding factor. There are very well experienced and versed folks behind the scenes that are driving the ship. But that is a helpful tool that we are seeing and using across a lot of our properties with our operating partners.
Yeah. So yeah, it's all, I mean, it's all intertwined. You've got the softwares, you've got your on-site property management team, and then yourselves or your operating partners as the asset managers that are kind of essentially just number of layers of decision making, but maybe even more importantly, just a bit of a checks and balances. Like, okay, if we just did what the software says, is that going to get us where our actual business plan wants us to be versus, what other decisions, what other levers can we pull to get this, property where we want it to be? And if you're, again, it depends very much on that business plan. As you mentioned, you like to be getting cash flow along the way. So you're not going to drop occupancy so that you can renovate, 20% of the units at a time. It's just, that's going to make that difficult. So I think importantly, understanding what the overall goals of your investors and your business plan, how that all ties in together makes a big difference.
Yeah, it's all part of the decision-making process, Jason. I mean, another thing to note, a lot of our operating partners have, what we call like insider information, right? Where they might own several other assets within the same submarket.
Yeah.
And that gives them a lot more insight as well as to the trends, the leasing velocity, the rental rates, the demand, parking, no parking, garage parking, how much do we charge for it? Oh, there's a wait list down the street for garage parking. The software wouldn't know that, right? And
Right.
so there's a lot of information that's also added to this decision making. A lot of times when we're working with an operator that has scale in a certain submarket.
Yeah. Yeah. It makes total sense. Um, you mentioned, sort of through the journey in the beginning, you were doing a lot of that active side of things, operating, and now you're more, sort of operating a private equity firm and investing with other operators. I guess maybe what made you make that switch? And then, kind of how did that transition work for you?
Yeah, great question. So that's a big part of our evolution, I think, organically, Jason, right? So when we first started our firm, it was really just to build on what we had been doing as a family, as an operating partner. And so from 2010 to 2017, we were the operating partner for 99% of our deals. And that means we decided everything, the paint color, the flooring. We made all the decisions. We managed the manager, the asset manager, you name it, all in house. And our investors trusted us, right, to make the right decisions and to execute on the business plan. That's why they invest with us. At the same time, from 2011 to 2016, I had left corporate America formally in 2010, and I had a 401k kind of sitting idle. It's like, gosh, well, what do I do with these funds, right? The stock market is super scary at at the time, and now you look back, you say, gosh, I should have put it all in the stock market. But I went out on this 2-year networking binge, I call it, Jason, where I just was a sponge for information and on different asset classes, different real estate strategies. I started every week or two, I was at another live meeting listening to some expert speak about a certain subject. And I learned a lot through that time period. Notebooks and notebooks filled with information, Jason, right? And so that was a big part of my evolution. But the goal at the time was to learn more about personally, like, what should I be investing in? Because you find out quickly you can't invest your retirement dollars in your own deals. It's a prohibited transaction. So I opened up a self-directed IRA and started investing passively as a limited partner into other sponsors and operating partners deals. At the time, again, 2010, 11, there wasn't a lot you could point at and say, gosh, this has actually done pretty well. We did find that mobile home parks, self-storage, some apartments had actually fared quite well through the recession, all other things considered. And so we started investing personally into those, again, as a limited partner. Myself, some of my family members, we did that for 5 years while doing our own deals as an operating partner. And over that 5 years, we made over 20 investments into 10 different real estate asset classes within commercial real estate, we invested in some oil fields in Texas. We invested in short-term debt funds. We invested in long-term mobile home parks. We tried a lot of things. But at the end of that period, we could kind of look at the data, the returns, the projections, the risk, and analyze and compare different strategies, different asset classes compared to what we were doing, where the market was likely to go. Again, not trying to time the market. Nobody can do that. But a lot of the deep discounted deals that we had been buying, direct from the bank, were dried up, right? Number of foreclosures were gone down, et cetera. And so we decided to ask our investors, hey, here's something else that we've been doing for the last 5 years. Are you guys interested in it too? And most of them said, yeah, we want to diversify. We'd love to get exposure to self-storage and these other asset classes, as long as it's with operating partners that you trust. And so we had built that trust, we had built the relationships, and so we started syndicating and raising capital and really focusing more on private equity again about 7 years ago, and got out of the formal operating partner space. And I wouldn't look back. If you look back today, I wouldn't change a thing. I think it was a really good decision for us and for our investors. And today we're very well diversified. And I think a lot of that is because of just the hunger and the thirst for knowledge and trying to understand, what else can we do? How else can we become better at this? And continuing to do that day in, day out.
Yeah, makes a lot of sense. I think, again, just going back to that sort of time horizon that we touched on before, but you took 5 years of investing as a limited partner, passive investor in other people's deals. You did 2 years of networking and educating and all of that. So I mean, I think it's just the willingness to put all that time in to get it, as right as you can. I mean, they're investments at the end of the day, and so it's like we can't always know exactly what's going to happen, but there are a lot of things we can know and be prepared for, and so that just comes down to putting in the time and the energy to find those out. So I love that sort of trajectory. I have I think similar aspirations myself. Right now I love the operational side of it. I love being an active investor, and I don't think I will ever get away from it completely, but I do look forward to getting to the point where that's sort of an optional thing for me, and maybe I will just want to invest with other people at some point. I don't know, but I think it's not an uncommon pathway. There's a lot of it's funny, you see a lot of people, when they think about getting started in real estate, they think they have to be an active investor. And they're like, I'll do it myself. I'll make more money that way, blah, 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 all of this. And then you do it and you're like, this is hard. this is just really hard, a lot of work, a lot of time. And so you see the people that have been in it as an active investor for a while, then go back, kind of the other way. And it's just an interesting path to follow, and I've seen that with a number of guests that have been in it for a long time, right? Like you kind of get to that point where you're like, maybe it would be better to just manage the money than than everything else. So it's really cool to see that how that's worked for you and your family.
It does help to have the hands-on experience, Jason.
Right.
Absolutely. Like when I walk properties today, I was at the property 2 days ago, with our operating partners and our asset management team. Like, you see things because you have experience, and you can add value on site, on the ground, and help out in that aspect too. And then you can also understand all the nuances with the day-to-day operations a lot better because you've managed a portfolio of properties that have rents due on the 1st and late notices out on the 7th, and this whole systematic process to ensuring that the property is performing. And so you can also helps identify if there's issues and problems at our operating partners, staff, and processes as well. And so the experience is great both ways. I don't think one's better than the other. It's just find out what works best for you and try going down that road.
Yeah, no, I 100% agree. That experience piece, even like my background before I was syndicating was in just construction, like residential construction. I worked since I was a teenager, I worked in construction. Well, that knowledge has been extremely valuable when it comes to, just like you're saying, managing construction projects on, instead of one house, it's a whole bunch of little houses stacked on top of each other. And it's kind of like all of that knowledge and experience just kind of rolls on top of each other and lets you, be able to go to that next level and feel comfortable with managing it, at whether it's as an active investor or fund manager, kind of wherever you are in the journey. It all I guess compounds on top of itself.
That's right.
Well, Mark, this is great. I don't want to keep you all day, but I want to ask you the questions that I get to ask every guest. First one being related to the name of the show, Know Your Why. So what's your why? You've been doing this for a long time. It's and we just talked a lot about kind of your evolution. So what keeps you going towards bigger and bigger success? Sounds like you've done a lot and already quite experienced. What drives you at this point?
I think a few things, Jason. First, I do love looking at deals. I will always love looking at investment opportunities, and so having that inner thirst for looking at a new opportunity is very helpful. I mean, we look at 10 to 20 deals a month. We invest in 5 to 7 a year, and so that's a big part of it to keep going, because you never know what's around the corner. So there's that excitement level, and you never know what could come next. Now, with that, as far as my why, I think it started back when I was in corporate America, just wanting to achieve financial freedom and not having a little bit more of a formal education. Going to school for finance, but they don't teach you how to balance a checkbook or teach you how to
Right.
borrow for a car. I could
Yeah.
tell you how to hedge 100 million yen, but I've never done that since I learned it in school. So
Yeah.
I learned a lot of things that were helpful in the process of how to learn something, but not applicable, right? Calculus,
Mm-hmm.
I haven't touched calculus in a long time.
Yeah.
And so there's all the subjects like, I call it personal financial planning. And I used to teach a course at a local community college about real estate investing. And a lot of the folks that show up are very good at what they do and successful and hungry, but also trying to achieve personal financial freedom. So that's been a big why for me throughout my whole career, whether it was in corporate America or at our firm and in between, is really just trying to get out of the rat race, determining what's the way to do this, reading a ton of books. Obviously, most folks have read Rich Dad, Poor Dad, but when I was in my early 20s, I read that, and that was a big wake-up call to being a W-2 versus a business owner. And so trying to spread some of that wisdom and knowledge I've learned over the years to other folks to help them get ahead is a big part of my why.
Yeah. I love that. Tell us something about yourself that isn't common knowledge. Special skill, a hobby, just something to let people know you better. Anything you're comfortable sharing.
Sure, yeah. Well, I'm married. I've got 2 kids, 5 and 7 years old. We live in Bend, Oregon, and we moved here about 8 years ago, kind of to settle down, have a family, Jason, right? But we ski a lot. So I've been skiing and snowboarding. I do both since, I started skiing when I was 5 and snowboarding when I was 9.
Oh, wow.
So in the 1980s, and still do both regularly. It's a big part of, for me, it's like I love balance in life. I work hard, but I also like to play hard. And so we live that way regularly. And a big part of it is being outside and enjoying the outdoors and sliding down the hill.
All right, follow-up question to that. Which do you prefer between skiing and snowboarding?
Depends on the snow, Jason. So
Really? Okay.
yeah, if it's powder, I'm snowboarding. If there's, a little firmer snow, ice, groomers, you name it, I'm usually taking 2 edges out on the skis instead of the snowboard.
See, that's an answer from someone who has experience with it, because I I mean, I haven't done anything like that in a long time, but I always liked snowboarding better than skiing. Just, I don't know, I felt more stable on it for some unknown reason. But yeah, if you're
Sure.
good at both, then you can actually answer that question. Other than which one do I feel like I'm going to fall less is
There
probably
you
my
go.
answer. Yeah.
That's good.
When people hear this and they want to reach out to you, Mark, what's the best place to reach?
Yeah, I'd say if you want to learn more passive investing, what we do, some of our investments, two things. One, you can go to our website, which I would encourage folks to do. It's smkcap.com and sign up. Join our investor group, and you'll start learning a lot about us, who we are, what we do. You'll get access to our investment opportunities and such. And then also for folks who have specifics, you can email me at info@smkcap.com. I answer all the emails and happy to chat with folks.
Great. And we'll put all that in the show notes too, so people can find you easily who are listening to this. My final question for you, Mark, is what piece of advice would you give to someone who is listening to this, they're inspired and they want to get started in real estate? What would you tell them as maybe some first steps to take?
First few steps for me are number one, networking. Who are you going to work with? Because this is not an individual industry. You work with folks. We work with folks every day, all day.
Mhm.
And so get aligned with the right people. That's always been number one for us. And number two is have that thirst, that inner drive to want to just learn. And if you don't have that, that's okay, but it's going to be harder for you to grow and excel because there's so much in this business that you have to know and understand in order to do well. It's not easy
Yeah.
and it takes time. But again, if you're aligned with the right people and you got the right mindset, you can definitely excel. And I think that the last thing is got to start somewhere, right? And so a lot of people, they're hesitant. They sometimes overanalyze and they might just continue to wait for a perfect opportunity. Well, a perfect opportunity is probably not going to come, but an opportunity is probably right around the corner. And so if you can see that and take advantage of it and at least start somewhere, that's the key. Then you can just keep going, but you got to start. So those are my thoughts there on that.
Yeah. All great advice. Thank you for sharing that. And thank you so much for coming on the show today. I appreciate your time very much. I think this is going to be a very valuable episode for people listening. So appreciate you sharing everything you did today.
Yeah. Thanks for having me, Jason. It was fun.
Yeah, absolutely. Folks listening, I know you're going to get a ton of value out of this episode. Please like, rate, and review so we can get more great guests like Mark. And thank you all for listening.
Hey there, I am Dr. Jason Ballara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?